Bitcoin faces critical technical resistance as geopolitical tensions reshape market sentiment in early 2026. Bitcoin is currently trading below $93,000 after a significant reversal on January 18th, driven by escalating trade tensions between the US and European Union. The cryptocurrency has declined nearly 2.5% to $92,663, reflecting broader risk-off behavior across financial markets. Meanwhile, silver, traditionally viewed as a safe haven asset and inflation hedge, typically benefits from the same macroeconomic uncertainties that pressure Bitcoin, creating an interesting divergence in how these two assets respond to current market conditions. The cryptocurrency market's recent volatility underscores a fundamental shift in how Bitcoin is being valued and traded. No longer purely speculative, Bitcoin's price movements increasingly correlate with traditional financial metrics, macroeconomic stability, and institutional capital flows. This maturation of the Bitcoin ecosystem means that understanding its price trajectory requires analyzing factors far beyond blockchain technology itself. Bitcoin's technical position reveals significant bearish signals emerging across multiple indicators. The asset currently trades below its 365-day moving average, which sits near $101,000, a critical barrier that historically halted recovery rallies during the 2022 bear market. This positioning suggests the market remains in bearish conditions despite earlier optimism about climbing back to $100,000. Analysts point to 5 bear market signals flashing for Bitcoin this January, including a bearish Kumo twist and negative cycle indicators that suggest the broader trend has turned negative. The Gaussian channel analysis on a 5-day chart shows Bitcoin has lost the channel's median level, a development that historically marked the start of more aggressive bear market phases. Crypto analysts warn that if Bitcoin fails to retest this median level successfully, it could signal the beginning of a steeper decline. The technical setup suggests potential downside targets ranging from $8,770 to $92,000, depending on which technical framework analysts employ. Machine learning algorithms provide conflicting short-term forecasts for Bitcoin's near-term trajectory. Finbold's AI prediction platform estimated that Bitcoin would rally only 1.6% by January 31st, 2026, rising from $93,013 to approximately $94,500. However, individual AI models showed significant divergence. Claude Opus 4.1 proved most bullish, with a target of $97,750, indicating a 4.82% rise, while ChatGPT 4o was most bearish, predicting a 0.55% drop to $92,500. These conflicting predictions highlight a fundamental limitation of AI-driven forecasts: their inability to account for unpredictable shocks like geopolitical risks or regulatory shifts that complicate valuation accuracy. The moving average convergence divergence, MACD slope, indicates a stronger bearish turn, showing a weakening uptrend. Conversely, Bitcoin's relative strength index, RSI, demonstrates that the asset appears neither overbought nor oversold as of January 19th, suggesting that recent dramatic price movements were primarily driven by external events rather than technical exhaustion. This distinction is crucial for investors attempting to differentiate between temporary volatility and genuine trend reversals. Macroeconomic factors dominate Bitcoin's medium-term outlook for 2026. Grayscale's 2026 digital asset outlook highlights that easing liquidity conditions, declining U.S. Treasury volatility, and regulatory clarity, particularly through measures like the Clarity Act, could propel Bitcoin to new all-time highs by mid-2026. These institutional perspectives suggest that if macroeconomic conditions stabilize, Bitcoin could potentially reach $150,000, $170,000 by mid-year, according to projections from Standard Chartered and Yahoo Finance. However, significant downside risks exist. A U.S. government shutdown, reversion in risk asset markets, or continued geopolitical instability could pressure Bitcoin toward $50,000 levels. The current consolidation phase, where prices trade between $92,000 and $98,000, reflects the tension between bullish institutional optimism and cautious risk management. This range-bound trading pattern is typical of markets experiencing fundamental uncertainty about macroeconomic direction. The geopolitical environment has emerged as a primary driver of Bitcoin's recent volatility. President Trump's tariff announcements and escalating tensions over potential annexation of Greenland have triggered risk-off behavior, causing investors to flee risky assets like Bitcoin towards safe haven alternatives. This dynamic reveals how Bitcoin, despite its technological innovation, remains highly sensitive to traditional geopolitical shocks, a characteristic that distinguishes it from earlier narratives, portraying it as independent from macroeconomic cycles. On-chain analysis provides additional bearish signals. Elevated exchange inflows combined with distribution from larger cohorts suggest the market is entering a more fragile phase. Institutional activity on exchanges tends to be more informationally significant than fragmented retail flows, as it reflects strategic decisions rather than noise. When large holders move Bitcoin to exchanges, it typically signals preparation for selling, which explains why on-chain metrics are flashing warning signs despite some technical indicators remaining neutral. Silver's role as a safe haven asset creates an interesting counterpoint to Bitcoin's current struggles. While specific price data for silver wasn't included in the search results, silver traditionally appreciates during periods of geopolitical uncertainty and macroeconomic instability, precisely the conditions affecting Bitcoin negatively. Silver's dual nature, as both an industrial metal and precious metal, means it responds to different market dynamics than Bitcoin. Industrial demand from manufacturing sectors provides a fundamental price floor, while investment demand surges during risk-off environments. The divergence between Bitcoin and silver during geopolitical crises highlights a critical distinction. Bitcoin is primarily a financial asset driven by sentiment and institutional adoption, while silver has tangible industrial applications alongside its precious metal status. This fundamental difference means that while both may benefit from inflation concerns, their responses to immediate geopolitical shocks can diverge significantly. Silver typically outperforms during acute crises, while Bitcoin may struggle if such crises trigger broader financial system stress that reduces speculative capital availability. Institutional adoption remains the wild card in Bitcoin's 2026 trajectory. Grayscale and other major institutions have positioned themselves for potential Bitcoin appreciation, suggesting confidence in longer-term fundamentals despite near-term volatility. The regulatory clarity provided by legislation like the Clarity Act removes uncertainty that previously deterred institutional capital flows. However, institutional adoption remains conditional on macroeconomic stability and sustained investor confidence in risk assets. The interplay between institutional adoption and macroeconomic conditions creates a feedback loop affecting Bitcoin's valuation. If institutions perceive macroeconomic conditions as deteriorating, they reduce Bitcoin exposure regardless of technological improvements or regulatory clarity. Conversely, if macroeconomic conditions stabilize and institutional adoption accelerates, Bitcoin could experience rapid appreciation as capital flows into the asset class. Current market positioning suggests institutions remain cautiously optimistic, but are reducing exposure pending clearer macroeconomic signals. Technical support and resistance levels provide crucial reference points for Bitcoin traders navigating current volatility. The $92,000 to $94,000 range represents critical support, with a breakdown below $92,000 potentially triggering accelerated selling toward the $80,770 Elliott wave target. Conversely, sustained trading above $95,938 on weekly closes could signal renewed buying interest and potential movement toward $100,000. The $94,500 level, identified by AI forecasts, represents a near-term pivot point where Bitcoin could consolidate before moving toward either support or resistance. These technical levels gain significance when combined with on-chain metrics and macroeconomic indicators. A breakdown through support levels coupled with elevated exchange inflows would confirm bearish on-chain signals. Conversely, if Bitcoin holds support while on-chain metrics show reduced distribution from large holders, it could signal accumulation by institutions preparing for the next bull phase. The convergence of multiple analytical frameworks, technical on-chain and macroeconomic, provides more reliable signals than any single methodology alone. The limitations of AI-driven price forecasts deserve emphasis as investors navigate current uncertainty. AI models trained on historical data struggle to account for unprecedented geopolitical events or regulatory changes that fundamentally alter market dynamics. The current US-EU trade tensions represent precisely the type of black swan event that confounds machine learning algorithms. Additionally, AI models cannot account for shifts in institutional positioning or changes in monetary policy that occur between training iterations. Investors should view AI predictions as one input among many rather than definitive forecasts. The wide divergence between different AI models, from Claude Opus predicting $97,500 to ChatGPT 4o predicting $92 out of $500, demonstrates that algorithmic consensus remains elusive in uncertain environments. This uncertainty argues for diversified positioning rather than concentrated bets based on any single forecast methodology. Hedging strategies using both Bitcoin and silver, or other safe haven assets, provide protection against the multiple scenarios AI models cannot reliably predict. Looking forward to February and beyond, Bitcoin's trajectory depends critically on macroeconomic developments and geopolitical resolution. If trade tensions ease and U.S. Treasury volatility declines, Grayscale's mid-2026 all-time high scenario becomes increasingly plausible. Conversely, If geopolitical tensions escalate or recession fears intensify, Bitcoin could face sustained pressure toward lower support levels. The current $92,000 $98,000 consolidation range may represent a crucial decision point where market participants reassess their Bitcoin exposure based on emerging macroeconomic data. For silver investors, the current environment presents opportunities if geopolitical tensions persist or escalate. Safe haven demand typically supports silver prices during extended periods of uncertainty. However, if macroeconomic conditions stabilize and risk appetite returns, both Bitcoin and silver could face pressure as investors rotate back into growth assets. The key for portfolio managers is monitoring macroeconomic indicators, treasury yields, employment data, inflation metrics. That signal which scenario is becoming more probable. Bitcoin's 2026 price trajectory ultimately reflects its evolution from pure speculation toward an asset increasingly tied to traditional financial metrics and macroeconomic conditions. The current volatility, while dramatic, represents normal price discovery in a maturing market learning to incorporate geopolitical shocks and regulatory developments. Silver's traditional safe haven characteristics provide a useful comparison point, highlighting how different asset classes respond to identical macroeconomic stimuli. For investors, the lesson is clear. Neither Bitcoin nor silver can be analyzed in isolation from broader macroeconomic and geopolitical contexts. Bitcoin's technical weakness, bearish on-chain signals, and positioning below key moving averages suggest near-term caution is warranted. However, longer-term institutional adoption and regulatory clarity provide potential catalysts for appreciation if macroeconomic conditions stabilize. Silver's role as a safe haven asset ensures it benefits from the very uncertainties pressuring Bitcoin, making it a valuable portfolio diversifier during periods of geopolitical tension. Monitoring macroeconomic data, institutional positioning, and geopolitical developments will prove essential for navigating both assets effectively through 2026's uncertain environment.